Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Hey, Jiwi says, dude, you're late. Yeah, I am. I totally lost track of time there, man. I was looking at a proposal and I got like really lost in it and yeah. Which is dumb because there's am I muted yourself? No, you should be able to hear me. We're okay. And you can see me. Anyways, this reaction to this statement, holy shit. Yeah, no, it's funny. This is this proposal, and I was just thinking about how I'm not going, I don't want to do it, and was thinking about how to talk about not doing it. So, was the dot plot like not what we thought? Fed will continue bond holding reductions as previously planned. Fed will continue same pace of reducing Treasury and MBS holdings. Median unemployment projection unchanged. Median forecast shows rates at 3.6 in 2025 and 2.9 in 2026. Oh wait, so what was it at the end of 2024? What was the unanimous? Rate forecasts show a wide range of projections for 2024. Okay, Nick Terminal Suites FOMC holds rates steady and retains a weak tightening bias in the statement. FOMC medium projection of 3 rate cuts for 2024. Gotcha. Okay, so This is actually exactly what we were talking about this morning, that the market expectation is that the Fed will say 2. And if they said 1, it will be hawkish. And if they say 3, it will be dovish. And now they are saying 3, and that is dovish. And so even though the market pricing right now is 4, them saying 3 is still a huge boost for the market. But with the current data that we have, I just don't see how we have 3 rate cuts next year. Are you saying that like it would require 3 rate cuts in order to get interest rates back to a neutral stance? I don't know, man. But the dollar got walloped there, down to 103.38. Treasuries extending here quite a bit. In fact, we're going to need to look at this. That is indeed above the highs from last week. This whole situation is just wild. This whole thing is just kind of... I feel that the Federal Reserve has let things get away from them, you know? And it's going to be very interesting because Jerome Powell, usually, when he comes out, is trying to avoid saying anything, right? His job is to get up there and talk and not actually give the market anything unusual to talk about. But that may not be what happens this time. By the way, I appreciate you guys sitting here and waiting while I was, like 5 minutes late. So. Everything is rosy and is going to be better as time goes by. We'll be singing Kumbaya. It's really like, okay, the market says there's going to be 4 or 5 rate cuts next year. And then the Federal Reserve comes out and says, okay, there might be 3 rate cuts next year. And then everybody celebrates because the Federal Reserve came one cut further to them. How is that? Like, I just and what's happening in the meantime? It's easing financial conditions. So if Jerome Powell doesn't come out and just absolutely smack the crap out of this market in the press conference, I think there's a very high probability, a very concerning probability that the inflation comes back. Serious. Because this kind of stuff is zany. This is in some respects more crazy than 2021. It's just this is just the I can't think of any situation. This has got to be this is one of those things where, like, having the experience and being in the market definitely helps you, right? Because if I was a new trader, I would be so effing confused, right? I would be so confused right now. that like the market pricing is not actually the market expectation for this particular event. That whole thing is just like, whoa. Oh man, S&P is up almost 30 points on it too. I would remember when I suggested that you spend money on a wig. That was too far. I apologize. I should have gotten a mega. No. I did buy one of those hats the first time around. But you know what I really want is a tinfoil hat. This is always one of those things I go around and kind of look on Amazon, like what is the best EMI lined hat? But we kind of dropped that one after they decided that the attacks on the embassy over in Cuba or whatever was actually just all in people's heads or something. Like, I don't. Anyway, look at the dollar. I mean, it's not that nuts. So let me come back over here. So when we come over to the JPY, the move in the dollar here, if you look at the bottom chart, the move in the dollar basically just wiped out the rally that we had on the 7th. After that was non-farms, wasn't it? No, that was the jobless claims. So the move in the dollar isn't actually that wild, but they're not done. What if the dollar really does start falling here? Well, it's going for new lows. Also, do the treasuries start moving in correlation, like the dollar falls and the treasury buys? Japanese yen sure took a jump. Gold and silver. Wow. So the biggest winners today, natural gas 2.28%, followed by oil at 1.21%, and then the ZB. Now, how is that when the yield curve steepened substantially again? Oh man, the move in the 5-year was actually really wild. Look at that. Woo! Did you see that whole spot that they just completely skipped there? Wow. You know, Federal Reserve meetings can be really wild. But lately they've been kind of tame. And the reaction to that release was the most extreme I've seen, I think, even before the pandemic. Like on the release itself, maybe like the overall day it's been different, but on the release itself, that's actually wild. And you know what? Like, I am surprised that it's 3. Like, so all of this other stuff aside, the expectation was that there would be two cuts. So them pricing 3 cuts is surprising to me. And is absolutely a reason for the treasury markets to be going wild here. It's just that, like, that's only on like that one thing. And when we look at the larger picture and like the larger fundamentals, this is insane. This isn't going to work. But I highly doubt that they're going to think twice about it today, right? They're just going to buy. And the market was waiting for this move. Well, I would say that it was largely in line with like whatever bets that people were placing, because we were up. But I mean, this is the thing, is that the last 2 really major, so non-farms, both non-farms and CPI were better than expected, and would suggest that monetary policy should get more hawkish, right? But the market brushed those off and then correctly front run this dovish FOMC statement. That's surely there's something in my own thinking about this that I'm not getting the full picture, because I basically, before all of this happened, I said these 3 data points, including the Federal Reserve meeting, are going to be hawkish, and they're going to sell it. And it's been the exact opposite. It's been nothing but buying. It's been nothing but buying. And it's not like I'm wrong about, I mean, I was right about everything in general. Like that the economic numbers were going to come in line with that, better than expectation, and that the market pricing is too high relative to what the Fed is going to say, right? But because the market thought that they were going to say 2 cuts, and they said 3, that's the only thing that matters. Isn't it? It's just like it always is. It's like you're right on like almost everything that you're looking at, but then you're wrong on something that you didn't even realize mattered. But I'm just at the moment having a hard time squaring this away with like my own expectations of the future, because I just don't see how this is a sustainable move. I don't see how this does not lead to like huge problems. What's going on here? There must be like oh wow, there are massive orders way up there at 29 7K lots. That's a little wild. Is there a way to keep market orders from disappearing on Jigsaw? Oh, that's a good question. I think that, have you tried putting it to 0? So if you come in here and you say the clear trades time interval and you put it to 0, then maybe it will never reset. I don't know. Or you could just put it to a really high number, right? So there's the Treasury 10-year already back up to the highs. And the dollar cratering further. And the dollar, gold. So if I come back to my volume profile and I look at gold, okay. Well, gold is nowhere close to where they were after, what was it? December 1st through the 3rd, that weekend, gold really took off. And that was kind of when this dovishness came in, and gold got battered back down. And now you've got to be sitting there in gold and be saying like they should be over 21.20, but that's still $100 away. $111.29. Those are 2.5K MBOs. Well, there's got to be more than that because there's 7K up there. So I think I need to change the depth here to more like 48, something like that. Okay, there's nothing beyond that, but there's 2 really massive ones at 29 and 29.5. Probably got to be looking at those as potential targets. I don't know. This one seems really risky. So like sometimes you can totally get a trade in here. I feel like it's already been too long. It's already been 20 minutes, believe it or not. Sometimes I might come in and say, oh, well, their initial reaction that they're going to go the other way. That happens a lot. That happens a lot. The funny thing is that this whole thing has been me saying, hey, what if Jerome Powell comes out and is really hawkish in his speech? And that, how would the market react to that now in this situation, right? But I'm not really considering too much the other side. What if he actually is like really dovish in his comments too? And then the market just extends on his comments. then it would really be like, wait, what? Okay, yeah. Do you understand the is instantiated on each optimization iteration? Can you shed some light on it? Do you use it? Yes, I can. So if your indicator has information that it keeps track of in between making calculations. So a good example of this would be cumulative delta. If I do cumulative delta, every time that a new bar is calculated, I'm saving the value and keeping track of it as we go. And so if I need to do, if that object was to be completely recreated, I would need to reset that value back to 0 if I'm doing a new back test, right? And so that is where you need is instantiated on each optimization iteration to be true, okay? But a lot of indicators, if you design them correctly, they don't have any kind of lasting calculation like that. They're only just looking at information in the current bar or within the last 5 bars, you say. And so they will... Yeah, my puts got it. They did. Absolutely. I mean, they've been obliterated long before this, but it was only one put. It was only like $100. So it's, I don't need to cry about it, but I am very, very shocked, obviously. Anyways, so if now the thing is that like instantiating the object is an expensive operation. So if you can write your indicators and your strategies in a way that you don't need to do the is instantiated on each optimization iteration, then your backtest will be faster. But I'm only talking about it from the perspective of the indicators. You kind of have to consider the strategy too, right? So like you'll very often have properties like that in your strategy, right? Things like, like there's some trigger, like I want this condition to hit and then this condition to hit and then this, and when I get all 3 of them are green, and then I can take the trade, right? And I'm using variables to store those. And so that's something that if there was a new there was a new optimization run, I would need all of those variables to get reset. And they do when you're recreating the object, but maybe not necessarily when you're creating a new thing. So you have to specifically address those, because you might be able to say if the data series, I forget what it is that you say, but I think that there's a way to say if I'm starting a new run, I just need to set these 3 variables back to 0. And then you don't have to recreate the whole object and do all that stuff. You took 3 trades. Wow. That's pretty ballsy, dude. Pretty ballsy. You know, it's actually kind of crazy to think about, like, just here in the micros that we were almost to 1 point. Well, let's say 19. Now we're at 071. So that was, if you had just been short up there from earlier this morning, $120 contract. I'm honestly, after watching that, a little terrified to trade. Because I'm looking at this like, well, I don't see how I buy that. I'm not going to sell it. Maybe when JPal starts speaking. I don't know, man. This whole thing has me all sorts of pent up. I don't know what to do about this at all. I think that what you do is you just let them do their thing, and maybe next week things shift. It's easy to read direction, but spots are weird. Yeah. Well, the liquidity is very light, and so the chances of it moving through you, whether you're long or short, are very high, right? And that's kind of the primary thing on my mind is the probability of adverse excursion is very high. And I don't know if I really want to risk a whole lot off of this thing. Especially if he's going to talk. I mean, like, will J. Powell speaking just completely flip this on its head? That's a real possibility. And then I come in and I decide to go short off of that theory, and he is actually really dovish. Well, I tell you what, for fun, let's I'm going to switch this over to my experimentation account in the Treasury, and I will build a position. Nope, it didn't like that. What did it not like? Okay. Yeah, I don't know, man. Taking 2 ticks out of a freaking... Oh my gosh, how big is this? 21. Yeah, taking 2 ticks out of his 64 tick range is not really too... That's actually likely what's kind of likely to happen to you, actually. Is you probably win, but if it doesn't work out, you just get slaughtered. Okay, well, I thought maybe I had a little bit of a spot where I could get a contract or 2 profit, and it didn't go. It went through me. So now I double down, right? No. I'm going to let it keep going until he starts speaking. And then I might double down. Pull up the live conference here. So I'm going to try to not be too loud this time because we really need to pay attention to what he says. If your MFU was good. But I mean, if it had gone 3 ticks against you, would you have bailed? That's kind of the question. Okay. So I guess I lied earlier when I said maybe I probably wait until he speaks. Because I'm seeing some massive icebergs in here. I might be like way off my rocker here because we could be in an we are kind of in an unhinged market to some extent, right? So they could just keep going, but seeing those big orders is something that makes me think that we're going to see a little shift here. Okay. Well, you did have hard stops at -4. See, the issue in a market like this is your stop gets hit. It might be -6. Right? So don't get cocky with those, because I've done that before, man. Okay, here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American
His opening statement was hawkish.
to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs-to-workers gap has narrowed, labor demand still
didn't
exceeds
fill me
the
there at
supply of
18.
available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I
Choose
are
tag
acutely
4.5.
aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to
I can't
returning
tell if he
inflation
had
to our
said something
2%
dovish there
objective.
while I walked away, or if that's just the
As I noted
range
earlier,
and trend.
since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility
there
off
was
the table.
4 of them that
The
thought there would
economy
be
evolves as
4, and there
projected,
was one that
median
thought that
participant
we're just going to
projects
go
that the
into a
appropriate
straight-up
level of the
recession
funds
then,
rate
huh?
will be 4.6% at the end of 2024.
And only 3 that thought that there would only be 1 or 2.
2025, and 2.9% at the end
The
of
difference between
2026.
3
Still above
and
the median
2
long-term
cuts
rate.
was only
These
one
projections are not a
person.
committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
That was your first question?
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that.
I thought the question was how long to keep it there.
People generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not.
Unpeak this because we're way too close to those big orders now.
That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was. And there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking
So
our questions.
basically, he's saying that
At
this
this
Federal
point,
Reserve
can
meeting
you
doesn't really
confidently say
represent
that
what the
economy
market
has
seems to be
avoided a
interpreting it
recession
is.
and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that
They didn't just spill those big orders. They blasted through that area. Wow.
Through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession.
So I haven't seen him say anything explicitly dovish, but I think what the market is doing here is very similar to what happened last time we had a Fed speaker, which is like they're looking at what he's not saying. He was given an opportunity to be very hawkish, and he's not. And so traders are taking that risk off of the table, and we're not getting any kind of reversion whatsoever.
When labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Howard.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year. Whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see
The move from like 24 to where we are now is really jarring to me.
enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward. But That's another assessment that we're going to make very carefully. So as time goes forward.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level with cuts beginning around March. Is this something that you are broadly comfortable with?
So this.
I love the way he asked that question.
For the sort of seesaw thing back and forth we've had over the course of the year of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, if we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%, but if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably we'll keep the labor market very strong. It probably will place some upward pressure on inflation.
I help you guys here in the press. The question you need to ask him is,
that could mean
the median forecast of three rate cuts or 75 basis points of cuts, would that, do you believe that would represent a neutral stance, or could that actually be supportive?
With Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other.
That
rate is
push through to
very
those
low.
big orders at 29.
These are- But
You won't see one like that very
development
often.
of the labor market has been very.
That's why I was like,
positive.
well, I'm
Good
just
time to-
messing around here, but I'm not
Get solid
going to
wage
be the
increases.
guy holding through that because I know what that means, right? So I bailed before it got there.
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now real wages are now positive, so that wages are now moving up more than inflation as inflation comes down, and so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is
What did
so
Jay Powell say?
beneficial for,
Nothing significant so
families
far, to be
and
honest.
companies around the country.
It's basically like before. The market seems to be more focused on what he's not saying.
Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
If the economy looks like it's starting to fall into recession, if the jobless rate starts to
No,
rise.
they held rates. They held rates,
something
and
we're hoping to see.
the
Obviously, we're
projection
hoping to see
in their
something
SEC
very
is
different, which
3
is
cuts next year.
continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data.
I
as I
so wish I was in
certainly
that press room right now.
Labor data would be
So they're
important.
not asking the right question.
If you
Question you got to ask is:
You can
is
describe a
3
situation
cuts
that way.
neutral?
if there were the beginning of a recession or something.
If there was a recession,
way
would
up.
you need to cut rates more than 3? Right? That's really the real question.
McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
It's not in the script. No, they're just
We're aware
not.
of the risk that we would hang on too long. You know, we know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, you know, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of them, one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. You know, we're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median growth, median participant wrote down 1.4% growth, but you know, we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and you know, the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, you know, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, you know this, but allow me to say it again. We don't debate or discuss what the right, you know, whose SEP is right. We just say what they are, and we tabulate them and publish them. So it's, you know, it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously the service sector is thought to be stickier, but we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. And in fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, you know, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina. Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, you know, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today, but I just wanted to ask, you know, how that kind of adds to your thinking, you know, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the, you know, the translation into PCE. So it's very, very late in the game, you know. But nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and do you see, I mean, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that you know the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags.
Nick should be the only one allowed to ask questions.
Has demand shifted more?
I do feel like some of them are not sufficiently prepared for the meeting. I do feel like in this one that I could have asked a better question than some of these guys.
Like it's ongoing, but I don't know if that's right. Maybe people just bought.
Because I'm not getting an answer to my question, which is reducing interest rates 3 times next year take interest rates to a neutral stance? Or is that to mean that maybe it's actually a little bit easy because we are expecting some economic weakness?
Now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are of course stickier. So when looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. You'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot.
But what is that point?
Restrictive policy is weighing on economic activity. It takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer. But if you look at what's in the SEP,
coming right back up here.
I think you'll see a reasonable estimate of the timeline.
So you notice every time that they ask him a question that would give him an opportunity to be hawkish,
I wouldn't want to,
and he passes on it, the market buys.
Because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this, we felt since the beginning that it would be a combination of 2 factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those 2 things were going to be necessary. Sorry, say the last part of your question again.
if there's something different about the U.S. economy.
Yeah, so it's not that, it may or may not be about different, the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, we had the view, my colleagues and I broadly had the view that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it goes down to demand, and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down, the labor market keeps getting back into balance, and it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
Is that the end? Looks like the end. It's taking him a long time to get his stuff together, though. Okay. Well, guys. So for starters, that's very interesting. Where's my music? So, first thing that stands out to me here is that was a short press conference, right? That only went 45 minutes instead of the usual hour, sometimes even further than that we often get. So only a 45-minute press conference. And like I said, some of the questions that they asked, the press was not prepared. The press came in thinking that Powell was going to push back against the market pricing of interest rates and the easing in financial conditions. And he didn't do that. And when he didn't do that, they didn't know what to do about it, which I think is kind of funny. The question that I would have asked is the market is, or your median FOMC projection suggests that there will be 3 rate cuts next year. Do you believe that 3 rate cuts next year would put the Federal Reserve into a neutral policy stance? Does that 75 basis points cut represent a neutral stance for the Federal Reserve? Or in other words, we're 75 basis points tighter than what neutral would be right now? That's what I really want to know. Because do you think that we're just normalizing, like the thing that I don't understand is, do they say, okay, this worked, we don't need to have interest rates higher anymore, and so we need to move back to a neutral stance? That's what it sounds like he said, right? But we do anticipate there will be a little bit of economic weakness in the beginning of the next year because, the effects of policy rates are lagged. So does that mean that you have to bring rates down a little bit? You need to be a little bit dovish to kind of bring things back, and then you can you can just leave it there. And when the market starts doing well, you can maybe start raising it again. Like this is a mid-cycle adjustment sort of I don't think that was really answered. And the bigger thing here is that like all of the things that the market really seemed to be interested in, Jerome Powell's response was essentially like, we're not looking at that yet. We're not considering that yet. We're not thinking about it like that. This is just like, we put our projections down and compiled it together, and this isn't, I find that very curious because it seems to me that the model that the market, if you were to consider the whole of the market as like a brain, this model that the market has to interpret what Jerome Powell means and whether it's hawkish or dovish for the economy seems to be very different from the model that Jerome Powell has himself in his head. Because I don't think that Powell thinks that he said anything dovish or hawkish, but the market is coming in here. He's just like, this is kind of a nothing burger meeting. Doesn't really matter. We're just going to put the plot out and answer. They didn't really do significant stuff in that meeting. But the market is like, well, he didn't say the hawkish things that we expected him to say. That must mean he's really dovish. Right? And that's where you get all of these things. So I'll give you as an example over here. So, by the way, I just want to show this picture again first. Hey, this is the dot plot that they gave. One of the things that was interesting, they said 3 cuts next year. Again, it was only like what? There's 1, 2, 3, 4, 5, 6. And there was 4 for 4 cuts. So I guess you would have needed 2 people to switch over for this one to have been more, right? This is what the market was expecting there to be more people on 4 cuts. But they're also showing that they're not as easy in 2025 as they thought they were going to be. So it's almost like they're easing a little bit more here so that they don't have to ease as much over here. One of them should have asked X the shelter component. Core CPI is below 1%. When will the Fed start cutting or QE again? Yeah. think they did kind of ask that though. Anyways, so anyways, I was going to come back here onto Twitter. That's what I was going to do. So, let's see if I can get these tweets that I was reading. Brannigan Barrett. I have never heard Powell this dovish. He has twice had the chance to push back against rate cuts, and twice he chose not to push back. Equity markets are going to explode higher into the year end. 10 days ago, you said that it's premature to bet on rate cuts, but today you tell us the FOMC has started the conversation about rate cuts. What has changed in the last 10 days? What have you seen in the data that has you scared shitless? Right? So that's the weird thing, is that now people are starting to come in here and ask, like, oh, wait a second. How is it we can start reducing rates? Like, do you really see that much pain coming through the pipeline that we need to cut rates that aggressively? Yeah, but Powell, yeah, you're right. No, you're totally right, actually. Brannigan is totally wrong about I've never seen Powell this dovish, because, yeah, back in there were some parts during the COVID crisis where, Powell was practically begging the market to, keep financial conditions easy and so forth. Yes, this is true. But it comes back to what the market thinks this all means doesn't seem to match up with what Powell thinks that this means. Yeah, COVID was like straight up, yo, buy this stuff, here is money. When COVID happened, they really acted so aggressively. I was very shocked by it. Even with as bad as COVID was, I was still kind of like, this, I don't want this to result in inflation. But I'm kind of asking the same thing right now, as I'm sitting here like, how do you start reducing rates in March and then just keep reducing them 2 other times that year for a total of 3 cuts that year and not overheat the economy again? Because what I'm looking at is a market that's ready to just go absolutely bonkers on anything that, if the Federal Reserve doesn't come out and say, oh, yeah, we're definitely hawkish. We are totally going to keep interest rates here for as long as is necessary. You guys don't even know. Don't test us, because I will absolutely just shoot those interest rates to the moon if you guys don't do what I tell you to do. If he doesn't come out and say that, then the markets are like, they're cutting, yay, I'll buy all the things. It's just absolutely nuts. The reality here is, to me, or what I think is happening right now, is that we had excess in 2021 that the market, that the Federal Reserve was way behind on. And so we made rates restrictive, and that restrictive stance has not done a single thing to remove that fluff from the market. They just kind of, they took their, they just kind of sat there and watched it happen and waited for them to get easy again, and now it's immediately right back in. And so I am concerned that, well, it could be one of 2 things. I'm concerned that either A, that we really are going into a recession, and they're just not, it's just not clear to us yet, but the market is starting to give us the first signs that we're going into a recession, right? Or the second thing is that this like starts going on like way longer, and we go back and forth between this, like, oh, okay, it's over now, and then it's not over, and you get a CPI or a jobs numbers that are just way too good that and forces the market to rethink this whole thing, you know? Yeah, historically, now that they are cutting, equities will sell off. I don't know. I don't know if we can really use the history in this case, for sure. Because he clearly doesn't think we're going. I mean, somebody basically straight up asked him that. Yeah, I mean, does you guys reducing it? Does that mean that you think that we're going in for a recession? He was like, no, we think that things are just hunky dory. Okay. Powell sounds like he wants to keep quantitative tightening going even after Fed cuts. Cuts are happening next year because inflation is coming down rather than economic weakness. That distinction can allow the balance sheet, quote, normalization to proceed. Some problems with that, right? There's some problems with that because the meanwhile, the Treasury has to auction off a ton. They have to auction off a ton of treasuries. How are they going to do that? One of these things cannot, these things can't all be right at the same time, for sure. Oh, man. I kind of feel like I'm rambling. I am shocked at everything. I'm shocked that it was 75 basis points of cuts. I'm shocked that Powell didn't push back at the market pricing whatsoever. I'm shocked at how much the treasuries have moved up today after that. And I'm just sitting here thinking, like, this can't all work. Something's gonna break. Like, this reminds me of after COVID when we were doing stimulus, you know, or like when we held off on raising interest rates while the real estate market was just absolutely bananas, right? Yeah, so he was like, he just wanted a quiet Christmas and a New Year's after all that has happened. So he was like, go home. You know what? That's so under the Akshay theory of forward guidance, Jerome Powell wants the economy to the market to continue forward as the same trajectory that it has been through Christmas, and then next year we can then say, actually, we're going into a recession, and everybody can panic, right? I'm gonna go before Seth shocks himself of a chair and we become witnesses. What do you mean by that? It's a great chair. I need to make a video about the chair over the Christmas break. I like it, chair. It's not perfect for all situations. Like, Mark sounds like a good time to inject some reality into the markets then. Yeah, okay. Can you imagine if the market was thinking like, oh yeah, so we're going to get the first cut here now, it's March, and then they raise, they don't, or they raise interest rates? That would be like, ugh. That would really hurt them, wouldn't it? Hey, yeah, go to bed, Dewey. Long day tomorrow. Start of spring and stuff. It'll be hilarious because of history rhymes and stuff. KRE is winner of the day. Banks balance sheets look A+ now. Ooh, yeah. This is a good point. I don't know. Like, I'm still of the opinion that the KRE will come back, but that's not necessarily where you want to have your money, right? Because when that was happening, everybody's like, okay, so do you buy the dip now? Because like stuff's happening. I was like, well, if you buy it now, I think that you probably will make money, but I don't think that it's going to be your best bang for your buck. Indices. Oh, come on. Regional banking ETF. There we go. Oh, wow. Yeah. That is pretty big jump. And Oh, it's new highs. They've got a ways to go before they retrace all of the bad that's happened. How much of a win would you have gotten? Let's say that you got long at 40 and now it's 50. So $5 out of 40. That's still a 20% gain on the year. I mean, that's still a great trade. I guess when I talk about these sorts of things, I think I'm looking for too big of a bang. You know? I'm looking to like double my money or better. But 20% gain on a year in an individual ETF is really good. Yeah, assuming that you bought it down here. It's probably still going to end the year negative on the year. Okay. So Financial Juice says early market on close in balance 261 million to buy. Oh, I'm sure that it'll be much larger than that. I think it'll be much larger than that. The more I think of it, the more I like Akshay's theory that Powell just wanted to have a nice Christmas. That's I should try and make it TikTok, even though I hate TikTok and I hate making, but I should try and make it TikTok to try and explain, because there's got to be people out there really confused right now, right? Now here's something else that's going on that we gotta talk about. Doubletree Capital's Jeffrey Gundlach, aka the Bond King, and this guy has been smart and pretty good to listen to since COVID. He says that we are likely to see the curve de-invert in the first half of 2024, and that the Fed may have to cut rates more than anticipated. So if we're anticipating 4 cuts, he's saying the Fed may have to cut more than that, like 5 or 6? What? Our CPI model suggests we'll only see 1 more month of a 3-handle print. Yeah, the Bond King who asked everyone to buy the long bond bank. He has made mistakes, for sure. This one kind of seems like I don't see how he can be. We're likely to see the 10-year treasury in the low 3% range sometime next year. What? I mean, I do remember when we first crossed 4 and it seemed like, well, we crossed 4 and then it came back down and then it went back up and it went to 5 so quickly. And now it has come all the way back to 4. And I remember thinking originally that like the 10-year should stay around 4. So now that we didn't quite touch 4% today in the 10-year, in the micros at least. And by the way, the 3 cuts for the projection that would have us at 4.5%. And where is the 2-year right now? 4.41. So the 2-year is kind of seems to think that they've got it right on. You know, 4.5, probably more chance that they have to do 4 than that they would have to do 2. Seems to be what they're pricing. So it's really those bills and like the FedWatch tool that's really going like, oh, what? How is that going to happen? But again, maybe we're just going to have a recession. Could be that we're way too, well, I guess what would be the best case scenario? I don't see how this scenario would work out, but the best case scenario would be that the Federal Reserve brings interest rates back 3 times next year, and there's absolutely no problems. That the stock market just, breaches out to new highs. We have huge gains, and absolutely nothing bad, no kind of inflation or anything results from any of that. I mean, in order to justify the way that the stock market is moving, I kind of feel like that's what has to happen. Kind of sounds a little fantastical, doesn't it? My face is tired from smiling too much. This has been a day. And for me, you know, it's a little frustrating, man. Not just it's more than just a little frustrating to not take a trade today and see the interest rates having moved so much. And then we come back here tomorrow and I'm going to be like, well, can we really buy it now? Like, after all that? Actually, I think you probably could. Of course, there will always be pushback, but I would bet that this move up would only just encourage more people to go along into bonds, probably. The market is pricing in double the number of rate cuts in 2024 than what the Fed projects. I would have thought that gold would be a huge winner off of all of this. It is a big win. Oh, actually, silver is the winner. Yeah, okay. I was going to say, I don't see why gold is not at the top of that list, but silver rose 4% today. That's good for me. That's good for me. Of course, my puts are going to expire worthless now. This was the last opportunity. Now they're probably only worth like $20. Shall we go find out? Let's go find out. How much are they worth now? The puts that I bought were already really cheap, so. I tell you what, the pullbacks on these have been pretty deep. They were like 20 tick pullbacks. Oh wow, my individual account is up really big today, actually. What's with that? Wow, yeah, because my Goldman Sachs is a bank and it's up 2.52%. Wow. And my puts are worth 1 cent now. So they were worth 7 cents and now they're worth 1 cent. Darn. I don't know. I still think, to be honest with you, yeah, so much for saying don't fight the Fed. I don't know if I feel like what this is doing is necessarily fighting the Fed, but anyways, what was I going to say before you distracted me there? Like looking back on this trade, the put, I think it was still the right choice. You know, if the market had taken, and this was before all this other stuff started happening. Okay, so kind of lost a long time ago. But, you know, with the information that I had at the time, it absolutely could have gone the other way. And if it had, I think that the treasury market would be hurting really bad right now, right? So I think that those puts would have been so on like a kind of a YOLO trade of sorts, except for there wasn't very much money. I think that it was a trade that made sense. But clearly my own kind of like prediction for how this was all going to go down was dead wrong. And that alone doesn't really bother me. But what bothers me is how the market seems to be able to to front run it so hard, right? Like how can they buy it up this hard, this and still Powell's too dovish, you know? That doesn't make a whole lot of sense to me. That's just too wild. That's just too like what it basically is the Federal Reserve is going to get dovish trade that you could have taken, I guess, at the beginning of November. When was it? This right here. Yeah, going back to the beginning of November 1st. Long there. That's too good of a trade. That's 6 handles. $6,000 on one contract. Trades that good aren't supposed to happen. Not in the treasury market, you know? How can that happen? And by the way, it's also kind of saying, well, I don't know. So something that happens off of this. I need to temper myself a little bit here. Because what usually happens off of these is it's going to come back. They might eventually do this. But it's probably going to come back and everybody will be like, what the heck? I thought this meant that everything's good and the Federal Reserve is just, you know, everything's awesome now. Right? And it pulls back like immediately when things look like they couldn't get possibly any better. But that's exactly when you sell, right? Yeah. I don't know if I was long on this, though. I don't think I'd be taking profits today. Maybe I would take profits on Friday. And then go on vacation early. And then come back in January and get long again or something. Yeah, let's just wait. Let's just wait for March. I am totally all in now on this. Actually, is, you know, I know it was just a joke, but I'm really liking it. They're dovish just for the holidays. They'll get more hawkish come March. Yeah. Well, guys, I don't think I have anything else useful to say to you. So, stay excellent, team. See you tomorrow.